Let's take this conversation forward. Ed Clissold, the chief U.S. strategist at Ned Davis Research, is with us. Ed, morning. Maybe you could hear some of what my colleague was just talking about. Rate decision, very important here in India. And rate decisions is where, the market is really focusing on the Fed next week. Perhaps 25 basis points is being considered a given. And on what's happening in Japan. And everyone's wondering if Japan will still hike rates because the way those bond yields are shooting up, that could have implications for global equities and the flow itself. So just give us your sense on the central bank tango, US looking to cut, and if Japan raises, then could that lead to more volatility in global stocks?
Well, good morning. First of all, with the U.S., a 25 basis point cut is pretty much baked in at this point. We've transitioned from a period of when it was just about Powell and what his views were, and you could basically assume the rest of the FOMC would follow along with what he wanted to do. Now it's almost like a corporate board. You have to count votes, and it appears now there's enough votes for a cut. We also think there could be one more cut within the first 3 meetings of 2026. And then after that, Powell's term would be up. So it looks like there's a movement towards a slow easing in the U.S. Now, when it comes to other central banks, they do have to play off of that. And I think that's the challenge for Japan of trying to hike too much when most of the rest of the world is cutting. And that could, kind of bring an end to this so-called yen carry trade. So I think that there would be some disruptions if the Bank of Japan moves too aggressively, but we've seen that in the past when that has happened. Markets usually adjust. It can lead to some volatility, but it doesn't necessarily mean that in and of itself would necessarily crack the 3-year bull market. So a lot going on with global central banks, but I think that the main thing to keep in mind is that the inflation fears earlier in the year haven't really come to fruition in the U.S., and so there's a path to modestly lower.
Yeah, well, let's see what today's PCE data indicates, and if it's pretty much the same trend, which is inflation is largely benign in the U.S. Ned, you've been, I think, pretty positive on U.S. equities for a while, specifically in terms of your exposure to U.S. tech. Have you changed anything? Have you taken some profits because of this whole debate on whether this AI bubble is going to unravel?
We've maintained our overweight, for stocks versus bonds, also growth versus value. Of course, tech is the biggest growth sector. So we've maintained that for the last 6 months or so. The reason for that is it's still a slow growth environment in the U.S. For example, about 12% of S&P 500 companies are growing sales faster than 15%. That's half what we've gotten in the past. And so investors are going to pay a premium for the companies that can deliver the growth, and that's the tech sector. Now, does that mean they can't get a little stretched from time to time? And there's going to be some fears over valuations. That seems to be the case recently. If you look at the relative PE for the Mag 7 versus the rest of the market, it's gotten to levels that historically have led to pauses in the Mag 7, and that's what we've seen lately. But the long-term story, that's where the growth is in an environment where it's tough to find growth, means that that's the sector you primarily want to focus on going forward.
All right. Hi, Ed. Good morning. Good to see you. And Nigel on this side. We're bracing for a new Fed chair as well. And hints are in place that Mr. Hassett has got the job. So let's see how that goes. But the view is that he's viewed more dovish. And we could see further rate cuts. Markets could rejoice in the near term, but ultimately that inflation worry could catch up. However, I think you're putting out a point that normally the markets welcome the new Fed chair with the near-term uncertainty and maybe a bit of a correction in the markets. Tell us about that data point.
Yeah, so if you look at the first 6 months of a new Fed chair, and this goes back, all the way to the early 1900s when the Fed was first created, on average, there's about a 15% correction in that first 6 months. And that's not point to point. That's just over that time frame, you get a drawdown of 15%, which is larger than what you normally see. I think what happens is the market's testing the new Fed chair. There will be a crisis that will pop up, and it could be anything. And because the markets don't know how that Fed chair would react, then it's kind of a shoot first, ask questions later situation. That happened in December of 2018 with Powell when he was trying to not lower rates as quickly as the market wanted. Eventually, he got the idea, but there was a pretty big drawdown in December of 2018. Now, there's a pretty clear potential issue for Hassett or whoever the new Fed chair would be, and that is the question of Fed independence. Where if there is one more or two more rate cuts between now and May 15th, Fed policy would be pretty close to neutral. And so how many more cuts would you need unless inflation drops a lot more than it is right now? So that could call into question those long-term inflation expectations, which have remained so well anchored over the past couple of years. Credit spreads, which have been very narrow, yield curve has not steepened too much. If those things happen early in the next Fed chair's term, I think the market will be sending a very clear signal they don't want more cuts. And that could be, politically a very tricky situation and something we really haven't had to deal with in 50 years since Arthur Burns in the early 70s.
All right, Ed, appreciate you joining in and giving us your view. We look forward to chatting up with you towards the end of this year or see you in 2026. Thanks a lot for stopping.